Let's stay overseas now, because as Latvia teeters on the brink of bankruptcy, Sweden is taking stock of the damage. Sweden's ill-fated foray into the Baltic banking sector may cost it 5% of national output. This is even after Latvia approved sweeping budget cuts to get its hands on an IMF-led bailout. Our Elliot Gotkin has been following the story, and he joins us now with details. And Elliot, would you say it'd be fair to say that Swedish banks bet the house on the Baltics?
Well, a couple of banks in particular bet about $50 billion. About 15% of their loan books are on the Baltic countries, these three countries over here. This is Latvia in the middle. So Swedish banks, SEB and Swedbank in particular, accounting for the lion's share over there. And they're being burned by these problems in Latvia and bringing Sweden down with them, really, because Latvia's economy is tanking faster than any other in the European Union. In the first year to the first quarter, I should say, Latvian GDP shrank by almost a fifth. 3 years ago, it was the EU's fastest-growing economy, with growth in excess of 10%. Sweden's finance minister, though, says his country can cope.
We have made clear that we have the resources and the ability to deal with whatever problems that might occur. I mean, we had a banking crisis back in the early 90s in Sweden, and I think we could deal with it quite forcefully if it's necessary.
Now, that, says Borg, could even mean taking over ailing Swedish banks. Latvia, meanwhile, is dealing with its problems with little help from its friends at the IMF and the European Union. They're bailing out the near-bankrupt Balt with a €7.5 billion, $10 billion loan. But to get its hands on the money, Latvian lawmakers yesterday voted to lop 10% off the country's spending budget, and as a result of that, the health minister has quit as well. Latvia's going to also be keeping its currency pegged to the euro and keep a lid on its budget deficit. But that at the same time could exacerbate the country's slump, and with the budget cuts all added in, these measures could actually undermine the ability of Latvian households and businesses to repay their debts. Many of those loans, of course, being owed to Sweden's banks, and if those loans do go sour, says Fitch Ratings, Swedish banks may end up costing their country even more than 5% of GDP, Scarlett.
Bloomberg's Elliot Gotkin.